Welcome back to the Market Board, everybody. My name is Dave, and today I've got an update after the latest earnings report on one of my absolute favorite companies out there, the original Bark Co., stock ticker BARK. Now, full disclosure, I'm so big on this company that not only am I a shareholder, but because I am also a customer of their service. If you're new here and you missed video number 1, what you missed was the history, management bios, products and services, partnerships, and a whole lot of more stuff. I'll leave a link down below so you can catch up because I'm only talking new stuff today. First, let's discuss some of the key details on the most recent quarterly call. Manish Joinja, the CEO, outlined their growth strategy quite simply. 1. Expansion into new product categories. 2. Scaling and optimizing existing products. 3. Enhancing cross-selling and add-on opportunities. And 4. Increasing their presence in retailers and other marketplaces. The product expansion investors need to be aware of, in my opinion, is what they're talking about with Bark Eats. Bark Eats is their highly personalized meal plan for your specific dog and delivered in portion daily meals. Their nutritionists maintain ongoing relationships with their customers, navigating a dog's wellness over time and recommending different meal plans and supplements as the dog matures. Now, currently, personalization in the dog food market is pretty limited and generally consists of a label on a bag indicating a puppy, a dog, or a senior. This presents Bark with a significant opportunity to capture market share of the $40 billion plus business in the United States alone. And the best part is, not only would they be creating a highly personalized and premium product, they would actually be offering it close to a mass market price point. Manish Joinja stated that Bark Eats would be ready for nationwide rollout by the end of the fiscal year. Now, something worth noting is that this was quarter 1 of fiscal year 2022, but he later clarified that it is already available to ship anywhere nationwide to customers today. They will just not be marketing it until later this year. In my opinion, this is an indication that they are likely trying to scale the size of the operation to be ready for higher volumes while also getting feedback on the quality of the product from current customers. With a little bit of hype now built up, before we move on to the fun part, the financial results, I just ask you to like the video, subscribe to the channel, and share the video if you truly care. But moving on to the financial results. The issue with many SPACs, in my opinion, is that they have failed to live up to the expectations they have set for themselves. Bark is quite evidently not one of them. In fiscal year 21, revenue outperformed guidance by 2.5%, delivering a revenue of $378 million versus the projected $369 million. Delivered fiscal first quarter 2022 revenue was $117 million, which was a 57% increase year over year, and they had provided guidance of $116 to $118 million, meaning they were spot on. Broken down, you can actually see that the direct-to-consumer segment, DTC, revenue increased 57% as well to $105.4 million year over year. Commerce revenue increased 58.7% to about $12 million, and this is all while maintaining robust gross margins of almost 60%. Comparatively, Chewy's only at about 26.5% according to Finviz.com. Add-to-Box revenue contributed to $7 million in quarterly revenue, which was up 173% versus fiscal quarter 1 of 2021. Bark reaffirmed both their next quarter and the full year fiscal guidance for 2022, including $516 million of total revenue at year's end. But something did catch my eye that was not as positive, and I think it's time we detail it. Monthly subscription churn rate had increased to 7.4% compared to just 6.2% the year prior. Now, if this number sounds high, it could be due to the formula that they actually use to calculate churn. If they use the same model as their peers, the churn rate actually would be effectively around 2.5%, meaning they would retain closer to 97.5% of subscriptions over the prior 364-day period. Now, there was a research group called Recurly Research, and they did a study to measure churn rates through various industries. and they found that box of the month type businesses churn rate on average was actually 10.54%. When you break that number down, you see that 9.41% of that typical churn is voluntary. That means people quit the service. And 1.13% is involuntary. That's something like the card canceled or their annual subscription ended and there was no renewal period. This exemplifies the strength of retention that Bark has maintained, in my opinion. Additionally, I think it's worth mentioning that I had some suspect outlook on their customer acquisition costs, which had increased significantly year over year, but management credited this due to the large number of signups during the same period last year when stay-at-home orders went into full force, which resulted in abnormally low customer acquisition costs. However, when you compare it to the prior quarter, you actually see that customer acquisition costs were actually down 6%, so I don't believe this is truly a red flag that it first appeared to be. Additionally, worth mentioning, they finished the period with a very healthy balance sheet, including $320 million cash on hand. Now, Bark has credited much of their success to their growth on social media platforms, and I don't disagree. Bark stated that this has allowed them to regularly partner with other iconic brands, including Warner Brothers and the NBA, two small companies you might have heard of. Because their margins are 2 to 3 times higher than that of a traditional marketplace like Chewy, and their social media presence, which exceeds 9 million followers across various channels, is significantly larger, they can have a truly disruptive presence, they believe, to what they call the dog market. To put that figure into better context, BarkBox's Instagram handle, and they have different handles for each of their product lines, has actually more followers than iconic lifestyle brands including Peloton, Oddly, and Beyond Meat. Now, my personal perspective here is that there really is no better way to reach Becky and her spoiled pup than through an adorable Instagram post and a clever daily tweet, and it certainly doesn't hurt that they're living in the convenience economy. Time to wrap things up here though. I want this to be a quicker video than my last, with my take and my updated position with holdings. At the time of the first video, I believe I had 950 shares. Somebody go back and check me on that. Since then, the price has declined, and I have subsequently doubled my position just about to 1,800 shares. My primary concern with the company was that it would become another SPAC with high dreams that would ultimately fall short on results. Now, while I don't like to talk about price action on the channel, as I believe it leads to short-sighted reactions, to roughly quote Peter Lynch here, quote, "Know what you own and why you own it, son." I know what I own appears to be one of the few vertically integrated dog brands, not marketplaces, that to this point have delivered on all their expectations. They have also projected higher growth than all of their comps, with significantly higher margins as well. I try to find companies that I think have a durable competitive advantage, and gross margin goes a long way towards achieving that. Additionally, the sales multiple for Bark when compared to others in the industry really does come as a surprise, in a really good way. All the following figures I'll show you come directly from finviz.com. Starting with my good boy, Bark, they have a market capitalization of about $1.44 billion on sales from the most recent fiscal year, not the most recent quarter, of $378 million, giving them a price to sales ratio of 3.81, posting an impressive gross margin of 59.3%. So then we compare that to Chewy, who has a market cap of $38.84 billion, with sales of $7.6 billion, giving them a price to sales metric of 5.07, with gross margins half of that of Bark at 26.5%. Moving on to Freshpet, they have a market cap, and this is where it gets fun, of $5.87 billion, which is about 4 times that of Bark, but their sales are only $370 million, meaning they did less in sales than Bark. That gives them a price to sales ratio of 15.83 with a gross margin percent of 42.5%. Something to note is that they can try to trade at a higher valuation sales multiple wise than Chewy because they have a significantly higher gross margin, but they're still less than Bark on that front. And then the final one we're going to lump in here is Trupanion, which I admit is a bit of an oddball, but it's a bit of a stretch to find these pet-related stocks. Market capitalization currently is $4.57 billion on $545.5 million in sales, giving it a price-to-sales ratio of 8.37. Something really worth noting here is that they have a gross margin percent of 15.6, which is the lowest in the group. As a result of this information, on top of everything else that I've presented, my conviction in the company stands very, very strong. Now, as a consumer, I would like to see more consistency on the delivery time of my packages, BarkBox, and that's really the only thing that keeps me from switching to Bark Eats is my concern that my meal might not arrive on time for my dog. But as an investor, I can just about guarantee right now that I won't be selling any of my shares in the pet company with the lowest price to sales ratio, the highest gross margin, the highest projected growth, and with a social media presence that actually rivals Peloton in a time in which we have never humanized our four-legged friends more. But just as one final reminder to everyone, I am an individual investor. I am not a financial advisor. This definitely should not be considered your financial advice. All opinions are my own and quite often are subject to changes during mood swings. My name is Dave, and this has been The Market Board.